Welcome to the Smart Investing Podcast, brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund.
Welcome everybody to Smart Investing, a Money and Me investor education initiative by PGIM India Mutual Fund. I'm Ahalya, and in this podcast series, as you know, we bring you insights on money management and simplify personal finance to help you build a lifelong skill important to make smart investment decisions, something we all can do with, especially in today's world of flourishing content where everybody has something or the other to say about personal finance. It can get a bit confusing, and we're here to cut through the clutter. Now, on today's episode, a very interesting conversation about a lesser known investment tool that can be very useful in some unique use cases as well as one's general investment plan. It's an interesting tool and not a one size fits all, and that makes it my favorite kind. So today we've got Ravi Samalad from PGIM India Mutual Fund in conversation with Lisa Pallavi Barbora, a financial coach and personal finance expert, to talk to us about systematic transfer plans and systematic withdrawal plans. Ravi, take it away.
Thanks, Ahalya, and welcome to another episode of Smart Investing. And in this episode, we are going to talk about a facility which is not so much in the limelight. Now, many of you are aware about the virtues of SIP, its flexibility, and how you can save and build a long-term wealth with SIPs. However, that is not the only tool available for you. There's also something called Systematic Transfer Facility and Systematic Withdrawal Facility, basically STP and SWP. And in this episode, we are going to talk about how you can make use of these important facilities offered by mutual funds. So Lisa, tell us how STP works and how we can make use of STP more efficiently while building our portfolios.
Hi Ravi. As usual, it's great to be on this podcast. And once again, you have pulled out a very useful topic to help listeners better their investment approach. And yes, STPs are a great enhancer. It's a simple tool really. What you need to do is take the lump sum you want to invest in equities, and instead of going head first into an equity mutual fund and investing the entire amount, what you can do is park that money in a very low risk debt fund of the same mutual fund house. Now, this could be a liquid fund or an ultra short term debt fund, but both these types of funds, they carry low to moderate interest rate risk, which means your returns don't fluctuate, don't move up and down much on a daily basis. Now you park your money here and then give an STP mandate to take money from this corpus instead of leaving that lump sum in your bank account and creating an SIP from there. So the enhanced efficiency of using, this STP route comes from the fact that the corpus that lies in your bank account waiting for its turn to be invested into equity earns, say, 3.5% a year, whereas the investments in a liquid or an ultra short-term fund can potentially give you better returns depending on the interest rate trend. That's where the efficiency of STPs comes from.
This definitely sounds tempting, and should one apply this strategy across the board to all their regular investments, or say someone who gets a regular income through salary versus freelancer whose income can be irregular? So can throw some light on this aspect.
Yeah, so as you were saying, how one is to apply this strategy will really depend on how they're able to structure their investments, which depends on their income and whether it's irregular or whether it's salaried. If income is irregular, say for like a freelancer, then perhaps in the months where you have large inflows, it makes sense to take it out of the bank and start an STP like investment strategy. Leaving it in the bank is not just about earning low return, as we spoke before, but also we get tempted to spend that amount, right? Very few of us have that self-control to not spend extra when we see that much more in the account. So for such investors, the thing to do is take out the expenses for, say, the next quarter and move the additional amount to a liquid or an ultra short-term fund and start that STP where the money gets systematically invested in an equity fund. For those who are salaried, a regular SIP is perhaps good enough because you have a certain monthly income which is coming into your bank, and it can be apportioned into systematic investments right away. There is no need to start like an STP. However, when you do get bonuses or you get an inheritance, those are lump sums that can again be structured into STPs so that you don't end up spending the entire amount. Again, Ravi, just for freelancers or if there are entrepreneurs with uncertain income, initially there may be nervousness about putting money into an STB-like facility, thinking that, what if the next quarter doesn't turn up as good as the previous one in terms of income? So, should you just put money into something like this? But it's important to have long-term investments anyway to cater to your future, financial security. And hence the STP into equity funds should be considered very seriously. Moving money out may also have the effect of, pushing one to ensure other ways to get that income flow to be steady in the next quarter as well. So if you don't have the money in the bank, then you may have, that extra motivation to go ahead and look for ways to earn more. And lastly, always, it's best to have an emergency fund anyway for 6 to 12 months worth of expenses before one starts, any kind of long-term wealth creation and investing.
Yeah, and in fact, if one doesn't have an emergency fund, then the SIP route can be used to invest in a liquid or a ultra short-term fund to create that as well. Now,
Right.
Another cousin of the SIP that mutual funds offer is the SWP facility. This too can be very useful for investors. So if you can explain how a SWP works.
Yeah, that's right. So SWP is somewhat like an opposite of an SIP. The full form, as you had said earlier, is Systematic Withdrawal Plan. And essentially what it does is allows you to withdraw small amounts systematically at a predefined interval of frequency from an accumulated investment corpus, which you may have in a mutual fund scheme. So the investment corpus may be invested in a debt fund or an equity fund, liquid fund. It really doesn't matter. You can create an SWP from any kind of mutual fund. You simply give an SWP instruction and access that money at a desired time interval and regular intervals. So, this is exactly like a second income, only that it's coming from your savings and your investments. But what you need to keep in mind is that it's not an immediate withdrawal from a lump sum investment, like we've seen with the STP. What I mean is that you have to first invest, let that investment grow a little before you think of withdrawing. Technically, you can set up an SWP and immediately start withdrawing after your investment is in place. But what will happen is that you'll end up withdrawing from your capital itself, as you have not given it enough time to grow. So now, our listeners will be thinking, then what is enough time to grow? How much time do we need? Well, that really depends on where you are investing. In any case, give your fixed income investments, in debt funds at least 2 to 3 years, and equity investments at least 5 to 7 years before setting up a SWP. Of course, the longer it remains invested, the better it is to set up SWPs.
Yeah, you rightly said that, after you create a corpus, then only you start withdrawing, because that corpus also need, time to grow, and the withdrawal rate has to be also correct. Now,
Right.
Are there any specific situations do you think investors should think of while using the SWP facility?
So SWP is really a great tool, and I can think of several use cases, but let's talk about 2 or 3 main ones to give people an idea. So the simplest thing that comes to mind is creating your retirement income. You start building your retirement corpus, say 15, 20 years beforehand. So what that means is you can use the SIP facility, pick a few diversified equity funds and start investing towards your retirement. In this long time frame of 15, 20 years, the fund corpus will grow and accumulate gains, right? Now, by the time you retire, it's really ripe for setting up an SWP for the amount you think you will need every month. And that becomes then your source of income when your active income stops. Now, in my opinion, this is a better way to create a retirement kitty than relying on an annuity. Because in case of an annuity, you are not always sure what the payout will be till the time, it is time for the annuity to start paying out. In case of an SWP, the creation of the corpus is also in your hands, as you are deciding what amounts to put together in the SIP, and the flexibility of the withdrawal amount is also with you. You can decide how much you want as income. You can reduce it, you can increase it based on the underlying corpus, and finally your needs when you do retire. Now, it's hard to foresee exact expenses in retirement sitting 20 years beforehand. Your best bet really is to invest in a disciplined manner and give yourself that flexibility post retirement. Another use case is, say, for your EMI payments. Now, your EMIs are, kind of sacrosanct. You must pay up on time, else, you'll have to pay a penalty. You may lose the asset and definitely harm your credit score. This is especially important for, long-term, large-size loans like housing loan or if you've taken a business loan. So what one can do is set aside the EMI for 2-3 years in a liquid or ultra short-term fund and use that to set up a disciplined monthly repayment SWP. In this way, you're not relying on your monthly income or salary. Those with fluctuating income really benefit from this structure, and even those with salary income, but maybe you're in an insecure job, then also you can benefit, because no matter what happens, in this way you are sure that your EMI will be paid up even if you are not paid next month. One more use case I kind of want to mention is an important one, is setting up an income stream for somebody who is dependent on you, mostly like children who have, say, special needs or are disabled in any way and not in a position to be financially independent. And that does happen. And, an SWP can be created as a supplementary income for this person, because even as an adult, this person will not be able to financially be independent. So this can even be set up as part of a trust, if that is the only way to care for a loved one in the unfortunate event of your own passing, right? So basically, you can create an SWP for any goal that is, say, some time away and requires kind of a regular income coming in. But using the facility as an alternative income source from a corpus that has had enough time to grow, that is basically the objective of having an SWP.
Yeah, as you rightly said, Lisa, there are several use cases of SWP, and it's good to know the kind of flexibility that SWP offers. Now that we have covered most of the ground, now I would like to come to the last question, which is what are the other important nitty-gritties that people have to consider before they start SWP or STP? What are in terms of taxation aspect, if you can throw some light on that?
Yeah, Ravi, one has to be mindful of these things. So firstly, let's be clear that every transaction of an SWP or a STP is subject to capital gains tax on the portion that does represent the gains. So let's assume that you have given an instruction of rupees 20,000 STP from an ultra short-term fund into an equity fund. If the per unit NAV or the price of the scheme is rupees 100 in a given month, then in that month you will need 200 units of the scheme to undertake the STP. If you have invested in the scheme a year ago and the NAV has potentially grown in that time, in other words, these 200 units were bought at a lower NAV a year ago, right? So when you are selling, the NAV or the price of these units has actually increased. So then there is some capital gains to contend with and some tax that you have to pay on this. And it's the same for SWP. So SWP is a systematic withdrawal. Every time that withdrawal happens, if the units were bought at a lower price and are being sold at a higher price, there is capital gains tax which comes into play. In case of a STP, gains are likely to be very low because the transaction happens kind of soon after investment. Hence, it's possible that the tax incidence is going to be negligible. In case of an SWP, remember that an ideal SWP will have a withdrawal rate which is lower than the average rate of gains that are accumulating in the scheme. So you have to be careful about that. Otherwise, as we had mentioned earlier, you could be eating into the capital. Other checks are pretty standard as with any other kind of mutual fund investment. First thing is quality. Make sure that whichever schemes you choose for STP and SWP, they have good quality portfolios and a consistent track record over a few years at least. Look for expense ratios which ideally should not be out of sync with the peer set. And lastly, remember, nothing is permanent. So check in and review your investment in a timely manner every year or so, and also consider your risk appetite before investing and choosing the funds.
Great, Lisa. So thanks so much for explaining how to use SWP and STP effectively. Now, as we wrap up our discussion, I would like to sum up the 5 important factors which every investor should be mindful of. The first one is the tax implications of STP and SWP. Both are treated as redemptions. The tax rate would depend on whether you're withdrawing from equity fund or a debt fund. Now, if you invest lump sum, choose STP to transfer it to another fund. The third point is STP can be used for rebalancing purpose as well. Basically, you can realign your asset allocation. And the fourth aspect is SWP can be used as a withdrawal tool during retirement. And finally, the SWP withdrawal amount, the rate needs to be less than the return generated by the scheme. Otherwise, you run the risk of exhausting or depleting your corpus early. So that was all about SWP and STP in this episode. Hope you all have understood the concept and its use case, and we'll be back with yet another episode soon. So thank you all for listening.
Thank you for that final summary, Ravi. I think that's exactly how we cut through the clutter. We've arrived at the end of this episode of Smart Investing by PGIM India Mutual Fund, folks. It isn't a one-size-fits-all tool, but a useful one to have in your armory of investment tools and practices. Thank you for tuning in, everyone, and I hope you took something very useful away from today's conversation. We'll bring you another one shortly, but in the meantime, happy investing. This is Mia Halia signing off. Stay safe and stay happy. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You are listening to the Smart Investing Podcast, brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund.